Like lower prices, how about lower prices on dividend growth stocks that now offer higher yields? Want to know about stocks that have totally cratered and are now way cheaper? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, if you want exclusive access to my personal six-figure stock portfolio and alerts on any new investments I make, check out the Patreon link in the description below. I'm not much of a shopper. I don't enjoy going to the mall and buying things. Personally, as far as material objects are concerned, I just don't spend a lot of money on that stuff. Stocks, on the other hand, drive me wild. See, high quality dividend growth stocks are my favorite merchandise in the world. And so the stock market is my favorite store in the world. Why wouldn't I be happy when the store is running a sale? When talking about dividend growth stocks, you have to understand that price and yield are inversely correlated. All else equal, lower prices result in higher yields. If you want to one day live off of the safe growing dividend income produced by your portfolio, lower prices and higher yields can make that happen that much faster. Today, I want to tell you about 5 dividend growth stocks that are down 20% or more from their recent highs. Ready? Let's dig in. The first dividend growth stock we have to talk about is Ally Financial Inc., stock ticker ALLY. Ally Financial is a bank holding company with a market cap of $8 billion. With a quote-unquote banking crisis upon us, which I happen to think is totally overblown, you already know that I have to feature at least one bank today. However, Ally Financial is a bit of a unique bank. Ally Financial can trace its roots back to GMAC, which was the financing arm of General Motors. GMAC became Ally Financial in 2009. Ally Financial now operates as a quasi-bank, but it's still heavily focused on auto loans. That makes it somewhat insulated from the current issues plaguing certain banks, but it also exposes it to what could be an upcoming spate of underwater auto loans. That said, Ally Financial has been putting up impressive numbers, especially when it comes to dividend growth. The bank holding company has increased its dividend for 7 consecutive years. That short track record is mostly a symptom of the fact that Ally Financial, as it exists now, is a fairly new entity, but it's been doing good things for its short history. The 5-year dividend growth rate is 24.6%. Even the most recent dividend raise came in at 20%, and the stock yields 4.7%. How often do you see a near 5% yield with a 20% plus dividend growth rate? Not often. And the payout ratio is only 29.1%. So even if there are some auto loan woes coming up, there's a nice cushion in place here. This stock is down a jaw-dropping 43% from its recent high. What's strange about this one though is that it doesn't necessarily track the rest of the banks. Most bank stocks are down heavily year to date, but this stock is actually up on the year. It's just that its 52-week high of $44.33 came about almost a year ago, and it's been mostly down since then, now sitting at about $25. But this stock has held up remarkably well in the face of industry-wide turmoil. Meantime, the slide, which started way before this spring, has created a very low valuation. Most banks command price-to-book ratios of between 1 and 2 depending on quality. That's during normal times. This bank's price-to-book ratio is only 0.7. The price-to-earnings ratio is 6.2. These are incredible numbers. If you're looking for a cheap and somewhat unique idea in banking and you want a high yield, Ally Financial is worth a look. The second dividend growth stock I want to highlight is CDW Corporation, stock ticker CDW. CDW is an information technology company with a market cap of $22 billion. CDW provides a range of IT solutions across areas such as analytics, cybersecurity, cloud, etc. Essentially, companies across the board have to manage their digital transformation and then their digital footprint thereafter. Companies like CDW help on both ends of the spectrum. They've been making a lot of money by doing so, and I don't see that slowing down anytime soon, which obviously bodes well for the dividend and the growth of it. The IT company has increased its dividend for 10 consecutive years. The stock's 1.4% yield isn't the highlight here. That's not what sells CDW. It's instead the growth of the dividend. The 5-year dividend growth rate is 24.8%. The most recent increase to the dividend came in at 18%. Huge double-digit growth here. And it looks very sustainable to me, as partially evidenced by the payout ratio of only 30%. This stock's 23% drop from its 52-week high may have created a rare opportunity. This was a $215 stock at the 52-week high. It's now a $166 stock, and that gap matters as CDW is one of those high-quality dividend growth stocks that almost always looks a bit expensive, but not now. Every multiple I look at is sitting below its respective recent historical average. The earnings multiple of 20.8 is a great example. Its 5-year average price earnings ratio is 24.7. So that's a pretty big disconnect. If your portfolio could use a major IT player with fairly high returns on capital and you're looking for a rare bargain, this could be the time to jump on CDW. The third dividend growth stock I want to bring to your attention is Domino's Pizza Inc., stock ticker DPZ. Domino's is a multinational pizza restaurant chain with a market cap of $11 billion. You know what's so interesting about Domino's? It's simultaneously big and small. This is the largest pizza restaurant chain in the world, yet its market cap is only $11 billion, which is actually quite small by restaurant standards. So it has scale, but it also has growth potential at the same time. That's really kind of a unique situation. What's also interesting about Domino's is that it franchises almost everything out. So it's just a recurring revenue machine. That's why it continues to rack up high revenue and profit, which has been fueling tons of dividend growth. The pizza chain has increased its dividend for 11 consecutive years. The stock's 1.6% yield won't knock you dead, but the 5-year dividend growth rate of 19% ought to catch your attention. A dividend that can compound at a high rate like that can turn into a very significant income source after a number of years. Using the rule of 72, a 19% growth rate doubles the dividend in less than 4 years. Just think about that. That's huge. And with the payout ratio sitting at 37.3%, we can be decently confident in the ability for this dividend to continue compounding. This long-term winner is suffering through a rare bout of underperformance, and it's down 27% from its recent high. Keep in mind, this stock is up by more than 400% over the last decade. That's right, what a winner, what a compounder. But it's been wobbling over the last year or so as the pandemic caused a huge run-up that has since deflated. The 52-week high of $426.44 is long gone. And maybe it was never deserved in the first place. Nonetheless, the current pricing of about $311 strikes me as favorable when looking at the long-term risk-reward setup. This stock's 5-year average PE ratio is 33.1. Now, it's 23.9. Still a bit elevated, sure, but pizza never dies. And I don't see this business, its stock, or its dividend ever dying. That level of relative certainty is worth a lot. If you haven't yet considered Domino's, now might be a good time to do just that. The fourth dividend growth stock we have to go over is Tyson Foods Inc., stock ticker TSN. Tyson Foods is one of the world's largest processors of various food proteins with a market cap of $18 billion. We have a very simple investment thesis here. People have to eat. If you don't eat, you don't survive. Going beyond the basic necessity of it, most people usually want to eat the best food they can get their hands on. That often leads to proteins like beef, chicken, and pork. Well, Tyson Foods is a massive processor of these proteins. Now, the company is facing some near-term margin challenges. The most recent quarter was, in a word, awful. But it's hard to imagine a world 10 or 20 years from now that isn't demanding what Tyson provides. And so that does augur well for the business and its dividend. The food company has increased its dividend for 11 consecutive years. The 10-year dividend growth rate is 27%. but it's super misleading in this case. More recent dividend raises have been in the mid-single digit range, and that's really where Tyson is at in terms of its dividend growth potential. In fact, with the business currently struggling in a very real way, near-term dividend growth could be quite muted. On the other hand, the stock's 3.8% yield is 150 basis points higher than its own 5-year average. That's pretty incredible. The 43.8% payout ratio, based on trailing 12 months adjusted earnings per share, looks okay, but profit is definitely moving in the wrong direction. So I'd say this dividend is shakier than it looks at first glance. Is this stock's stunning 46% fall from its 52-week high a chance to be greedy while others are fearful? I'm mixed on this one. If you bought this stock at or near its 52-week high of $94.77, you have my sympathies. But for those looking to get in now, the stock's current pricing of about $50 sure looks a lot more appetizing. Look, price is what you pay and value is what you get. In this case, the price has fallen significantly in a pretty short period of time, but the value of the business also looks to have fallen. We last analyzed and valued Tyson Foods late last year, with the fair value estimate coming out to $81.83 per share. Now, I came out a lot more cautious than Morningstar or CFRA. My dividend discount model analysis came up with a $68.48 per share fair value. I'd probably bring that down after reworking the assumptions, but for contrarian investors who like to charge in, Tyson Foods is interesting here. The fifth dividend growth stock I should bring up today is Whirlpool Corporation, stock ticker WHR. Whirlpool is a multinational manufacturer and marketer of home appliances with a market cap of $7 billion. Appliances, not exactly the sexiest products out there, but guess what? Hard to live life in our modern day society without, say, a refrigerator. And when it comes to appliances, Whirlpool is known as one of the best out there in terms of brand names. It's synonymous with quality and durability, which keeps the customers coming back time and time again. And that should keep the dividend growing time and time again. The appliance maker has increased its dividend for 12 consecutive years. A 10-year dividend growth rate of 13.3% looks great, right? Well, get this, the most recent dividend raise, which was announced last February, was a whopping 25%. However, the dividend has gone 6 quarters in a row at that rate, so that's mildly concerning. Then again, the stock yields a monstrous 5.1%. With that kind of yield, one can forgive a delayed dividend raise, right? Perhaps, with the payout ratio sitting at 50% based on midpoint guidance for this fiscal year's earnings per share, there is room for a higher dividend, but the economy is quite uncertain right now. This stock's 30% retreat from its recent high has made the shares look much more appealing. I've never really been a fan of appliance companies. The returns on capital are low, the margins are thin, and when the stock was priced at $196.30 back at its 52-week high, it also suffered from a challenging valuation, but it's now sitting at about $137, and the valuation has become undemanding. For example, based on that aforementioned guidance, the forward PE ratio is 9.8. The stock's own 5-year average price-earnings ratio is 13.6. If you have room in your portfolio for an appliance company, and if you're looking to jump on a 5% plus yielder while it's way down, Whirlpool should definitely be on your radar. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about these 5 dividend growth stocks that are down 20% or more from their recent highs. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.